The state might be encroaching too far on European banks. Government should note, strong lenders make a strong economy. And this is Jérôme Legras in the Markets Insight section of the FT website. He is not an FT journo. It says he's managing partner and head of research at Axiom Alternative Investments. Never heard of them. Large European banks have excess capital of more than 500 billion euros. For listed banks, this represents 43% of their market value. In a world where banks were free to remunerate shareholders as they wished, while keeping capital above minimum requirements, they could pay 43% of their entire market value as a special distribution. This is a stunning number, and yet European banks trade on an average valuation of 0.6 times of their book value. This isn't new. Banks have been trading at low valuations for a long time. For years, the blame was mostly on negative interest rates, hurting profitability. The reversals of monetary policies worldwide have changed that, and expectations of banks' profitability has risen sharply. So what's going on? Back in the mid-2010s, there was an old joke about banks' excess capital. As a shareholder, you'd be a fool to believe it belonged to you because it belonged to governments. They would take it through fines for past misbehaviours or new capital requirements. But that also is a story of the past. The Basel IV revamp of banking regulations is almost finalised, and global litigations are falling fast, except maybe for a few banks. Have governments found a new way of taking banks' excess capital? There is a theory gaining traction that at times are eerily like the 1970s, with deflation, recession, and energy shocks, etc., and that, as in the 1970s, this will lead government to control banks and credit excessively, something that will ultimately hurt shareholders. There are indeed some worrying signs, of which I will describe four. At the onset of the COVID-19 crisis, the ECB imposed a blanket dividend ban, whatever the strength of the bank's balance sheet. This was justified not only on the solvency grounds, but also because banks are needed to continue to fund the economy. The underlying assumption, banks must act in the general interest, not in their own, sounds very noble, but is also not usually associated with private companies. Banks should normally be free to contract or expand their balance sheet depending on their perceptions of the economic environment. Additionally, during the pandemic, a large share of new loans were guaranteed by governments. In theory, a bank's role in the economy is to allocate capital and assess risks. When they lend hundreds of billions with state guarantees, they're effectively transforming a big part of their balance sheet into quasi-government entities. The rise of environment, social and governance factors is also directing banks as lending more. This works in subtler ways with complex regulatory disclosures and veiled threats of higher capital requirements, but the conclusion is the same. Bank lending is channeled to some specific sectors based on considerations that are not entirely financial. It's very easy to understand the dramatic need to fund the low-carbon energy transition, but discussions around the taxonomy or exclusion of some sectors, such as weapons, are more difficult. Bank shareholders might have the impression that they are asked to do the jobs of lawmakers, afraid to take the decisions themselves. Finally, recent tax developments have reinforced the idea that a bank's money is government's money. After years of depressed returns, some countries, such as Spain and the Czech Republic, have decided to impose a bank windfall tax to offset the effect of new monetary policies. The financial impact remains modest, but investors are afraid of generalization and permanency, especially as central banks face large losses on their quantitative easing bond buying programs as interest rates rise, losses that will be passed on to governments. The temptation to recoup those losses will be huge. Still, I believe we should not exaggerate those trends. Most lending remains unconstrained. Moreover, COVID was truly an unprecedented event, and the argument that there will always be another crisis to justify government intervention is a bit weak. But this should be a warning. A world of low rates has brought us capital misallocation. It would be a shame to replace one misallocation with another one. From 1972 to 1985, France had a quantitative credit control system. A few years after it ended, the country faced its worst banking crisis since World War II, according to the Senate, and part of the damage was done by 13 years of credit control. We should not repeat those mistakes. Strong banks make a strong economy. Let's just have a quick look at the comments. By the way, it says here, Axiom is an investor in bank shares and bonds. So it's very much pumping the bank stocks. Agree with the author, the importance of the European banks is shrinking, their profitability is poor, and they are surely not safer than US banks. There are many reasons for this, but some of them can certainly be traced back to the ill-conceived involvement of European public bodies. You live in a socialist superstate, what do you expect? Mr. Legras has apparently missed the great financial crisis of 2007-2008. Alternatively, he knows about that, but he owns shares in European banks and would like a windfall profit at the expense of government and taxpayers. Government and taxpayers bailed out the banks to stem the global financial crisis. That's why we need strong capital buffers in banks. Exactly correct is the reply. Take the profit, then socialise the debt. This is the very reason we have bigger financial meltdown this time, because governments in wealthy Western world rewarded failure. The banks and people who stole the money in 2008 and 9. I wonder if the author is long of bank shares. The age of bank shares is back. They are undervalued. Profitability will improve with the base rate rises. Sure, let's have shareholders properly remunerated. And the taxpayer pick up the tab when inevitably things go south. Let banks be overcapitalized and boring, and tell this guy to go kiss an elephant oversized derriere. The state may be encroaching too far is a phrase I thought was strictly forbidden in the Financial Times. How did such heresy get past the FT editorial board, comrades? The arguments from the author investors are forced and wrong. Banks are by definition different to normal private companies. They're highly leveraged entities that use resources, customers' deposits that do not belong to them to take risks and make a profit. This is unique. In a global pandemic, governments lent an extraordinary amount of their balance sheet to limit scarring to the economy against the worst unknown public health crisis in more than 100 years. Banks benefited enormously from government guarantees. Additionally, the ECB, TLTRO, and other monetary exercises has generated a huge profit carry trade that has propped up the banks. Without these government guarantees and other central bank supports, what does the author believe European bank valuations and profits be?